highly paid professionals with research teams and Bloomberg terminals, and a simple index fund beats most of them. Here's the proof. Somewhere in a glass office tower right now, a professional fund manager with an Ivy League finance degree, a team of analysts, and access to research most of us will never see is trying to beat the stock market. He is paid handsomely to do exactly this, to outperform a simple, boring index that anyone can buy in 15 minutes from their phone. And here is the uncomfortable truth. The financial industry does not advertise loudly. Most of the time, he fails. Not occasionally, not in a bad year. The majority of professional fund managers, over any extended period of time, fail to beat a simple total market index fund. In this video, we are going to walk through exactly why that happens, what the data actually shows, and why jlcollins, the author of The Simple Path to Wealth, built his entire investment philosophy around this one uncomfortable, liberating fact. Let's start with the basic distinction, because it matters for everything that follows. Active investing means a professional fund manager is making ongoing decisions, which stocks to buy, which to sell, when to buy them, when to sell them, attempting to outperform a benchmark like the S&P 500. You pay for this active decision-making through a management fee, typically expressed as an expense ratio, often around 1% of your invested assets per year. Passive investing, by contrast, means the fund simply tracks an index, a predetermined list of companies like the 500 largest U.S. companies in the S&P 500, or the entire U.S. stock market in the case of a total market index fund. There is no human making active buy and sell decisions. The fund just owns what the index owns in the same proportions and adjusts automatically as the index itself changes. Because there is no team of analysts and no active decision making required, passive index funds charge dramatically lower fees, often a tenth of what active funds charge, or even less. Now, here is the number that changes everything. Independent studies tracking fund performance over 15-year periods consistently show that approximately 82% of actively managed funds fail to beat their benchmark index. Let that sink in for a moment. 82%. These are not amateur investors. These are professionals with credentials, with teams, with access to information and analysis tools that an individual investor simply does not have. And still, the overwhelming majority of them fail to do what they are paid to do. Beat a simple, low-cost alternative that requires no skill, no research, and no ongoing decisions at all. Why does this happen? There are a few compounding reasons. First, markets are remarkably efficient. Information about public companies spreads incredibly quickly in the modern world, which means it is extremely difficult to consistently find mispriced opportunities before everyone else does. Second, and perhaps more importantly, fees create a persistent drag. If an active fund charges 1% annually, that fund manager does not just need to match the market. They need to beat the market by more than 1% every single year just to deliver the same net return as a passive index fund, compounded over 15, 20, 30 years. That fee drag becomes enormous. Third, frequent trading inside active funds creates tax inefficiency for investors holding these funds in regular taxable accounts, since each trade can trigger a taxable event. Passive funds, which trade far less frequently, are inherently more tax efficient. If you want the single most powerful piece of evidence for this argument, look no further than Warren Buffett, widely considered one of the greatest investors in history. Buffett has publicly stated repeatedly that he wants the majority of his own wife's inheritance after his death to be invested in a low-cost S&P 500 index fund. Not in Berkshire Hathaway, the company he built and ran for decades. Not in a basket of individually selected stocks chosen by professional managers. A simple index fund. Buffett also famously made a 10-year bet. putting real money behind the claim that a simple S&P 500 index fund would outperform a basket of hand-picked hedge funds, funds run by some of the most sophisticated investment professionals in the world, charging substantial fees for their expertise. Buffett won that bet decisively. The index fund significantly outperformed the actively managed hedge fund basket over the full 10-year period. If the person many consider the greatest investor alive believes that simplicity beats complexity for the vast majority of people, including the people he loves most, that should tell you something important about where the real evidence points. Let's make this concrete and personal. Imagine you have $100,000 to invest, and you are deciding between a low-cost index fund charging 0.04% annually and an actively managed fund charging 1% annually. Both assume to deliver the same gross market return before fees for the sake of comparison. Over 30 years, assuming a 7% average annual market return, the index fund investor ends up with significantly more money, often well over $100,000 more, purely because of the fee difference compounding over time. That is not a small rounding error. That is potentially the difference between retiring comfortably and having to work several additional years. And remember, this comparison assumes the active fund matches the market's gross performance before fees. But we already know that the majority of active funds actually underperform the index, even before fees are subtracted, which makes the real-world gap even larger than this simplified example suggests. This is exactly why Collins built his entire investment philosophy around simple, low-cost, broadly diversified index funds. Specifically, he recommends VTSX, the Vanguard Total Stock Market Index Fund, which we will cover in complete detail in next week's video. The core principle is this: rather than trying to identify which active fund manager will be in the lucky 18% that beats the market over the next 15 years, a bet that is genuinely difficult to make in advance since past outperformance does not reliably predict future outperformance. You simply own the entire market yourself at the lowest possible cost and let economic growth work in your favor over time. You are not trying to be smarter than the market. You are accepting the market's average return, which historically has been excellent, while keeping nearly all of that return for yourself instead of handing a meaningful portion of it to a fund manager who, statistically, is more likely than not to underperform anyway. Now, to be fair, there is a legitimate counter-argument worth addressing. Some active fund managers do beat the market, sometimes for extended periods. The challenge is identifying in advance which ones will do so, before the fact rather than after the fact, when it is too late to benefit from that knowledge. Studies show that past outperformance is a remarkably poor predictor of future outperformance. Funds that beat the market for 5 years are not meaningfully more likely to beat it for the next 5 years than funds chosen at random. This unpredictability is precisely the problem. You are not just betting that skilled managers exist somewhere in the world. You are betting that you, in advance, can correctly identify which specific manager will be skilled and lucky enough to outperform over your specific investing time horizon. That is an extraordinarily difficult bet to make reliably, which is exactly why Collins, and increasingly the broader financial research community, recommends simply not making that bet at all. So here is the takeaway. Index funds are not a compromise, a lesser option for people who cannot afford good advice. They are, according to decades of consistent data, frequently the superior choice even compared to expensive professional management, lower costs, broader further diversification, less tax inefficiency, and freedom from the impossible task of predicting which manager will outperform. All of this stacks heavily in favor of the simple approach. Next week, we go one level deeper. We name the exact fund Collins recommends, break down precisely what is inside it, show you the historical performance data, and walk through the exact steps to buy your first shares. If this video changed how you think about investing, make sure you are subscribed, because next week's video is where the strategy becomes specific and actionable. See you then.